Alright, very warm welcome everybody to this week's week ahead video for the trading week starting on the 18th of January. Now there's a couple of things that we need to touch on, so let's jump into the video straight away. Now for the biggest part of this past week, we saw majority of risk assets trading more range bound, as we can see in the price action for the S&P 500, or this is the S&P E-mini. But until Thursday, of course, Thursday we had the unveiling of President-elect Biden's incoming fiscal stimulus package relief plan, and the plan is expected to cost somewhere in the vicinity of $1.9 trillion US. But the markets did take a little bit of a sell the fact reaction on the back of that unveiling. There was also some concerns about the possibility of increased taxes and the odds of the incoming stimulus package actually being able to pass through the Senate successfully, which caused some jitters in the global equity markets. And the risk of turn saw another additional push to the downside, of course, as we ended the session on Friday. Now the move lower in equities also coincides with some pretty bad economic data we had over the past 2 weeks. We had a pretty big miss in NFP last Friday. We had a big miss in initial jobless claims earlier this week on Friday. We also had a much bigger than expected drop in retail sales. And there is also the political uncertainty with the Biden inauguration coming up later in this upcoming week, which some fear could spark some additional violent riots and of course protests. Now at the very same time, there's also been some short-term sentiment-based indicators that have been warning of some complacency with the recent bullish rise that we've had in equities. And a good example of that was the put to call composite ratio, the normal put to call ratio, which traded back towards the 2012 levels earlier in the week. And in this publication earlier this week, the Daily Shot actually highlighted the extreme high volume of US equity call options that we saw, almost reaching the same type of levels last seen during the dot-com bubble back in 2000. So it's only natural then that traders and investors should pose some questions about this move lower that we've had in risk assets at the latter part of the week. And the question, of course, on everybody's mind right now is this move lower the start of a much deeper correction like the one we had back in September or October 2020, which warrants some patience from the bull side, or is this just a temporary pullback to look for some dip buying opportunities? Now, this is a very good question, and I think it's always important to view the current economic climate that we're in, the market climate that we're in, when we compare it back to previous areas or times when we had sell-off. So if we compare the September risk sell-off that we had, which was quite a sharp one, even the October one, I think there are some very important and stark differences to keep in mind between what we had running into this sell-off and what we have running into this minor one we had on Friday. Now you will recall back in September 2020, markets were hoping for that first vaccines to get approved and hoping for approval by the first quarter of 2020. And if we fast forward that 4 months, we have multiple vaccines already being distributed across the globe. And this recent data that we can see here from ourworlddata.org shows that almost 40 million people have already been vaccinated from December 14. Now keep that in mind, total cases confirmed across the globe right now is sitting at 94 million. So we're almost at half the amount of total confirmed cases in terms of actual people vaccinated. So not really a apple to apple comparison in terms of the virus front, if we think about it that way, despite the fact that we've seen quite the rise in recent confirmed cases. Also keep in mind that the shakeout that we had in September and October 2020 had a lot of election risk being priced into the markets. And with that now out of the way and the blue sweep victory now confirmed, that is one less issue for the markets to worry about going into the new year. Now, you guys will recall back in September 2020, the markets were hoping that there will be a new incoming stimulus package by the fourth quarter of 2020. Now, fast forward that 4 months later to where we are right now. We've had a down payment stimulus package, in the words of President Biden, that was approved in December, and the incoming administration has already announced their plans for yet another big package, of course, with $1.9 trillion US. So yes, due to more fiscal conservatives on either side of the aisle, we might not get that full $1.9 trillion, but I think the point of the matter to take away from all of this is that there's even more fiscal stimulus incoming that the markets had previously expected. Then the other thing to keep in mind, of course, is the easy base effects that we had in quarter one of 2020 that didn't suddenly just go away. The fact that we are moving into a period, especially this first and second quarter, where we are going to see some of the easiest base comparisons ever, should mean that the actual data coming in from middle of quarter one and at least up until the start of quarter three should be more reflationary, as we see growth and inflation, likely coming in higher again, just purely due to that very, very low base effect that we had for things like growth, that we had for things like payroll, things like the unemployment rate, and of course things like inflation. Now, the one similarity to now and September 2020 is positioning. Back in September 2020, the S&P was sitting with a net short position. If we take a look at that end of August, sitting at negative 86,000, negative 25,000, compared to a very similar scenario right now with the latest CFTC data on Friday showing a net position of negative 17,000 contracts. So the fact that call options have seen a huge spike is obviously a cause for concern. But in terms of just positioning on itself, what we're seeing right now is hardly looking like a market that is way too or all in bullish right now. The other factor to keep in mind is, of course, monetary policy. Arguably, one could say that the market's expectations for monetary policy was much more bullish for the Fed and for risk assets back in September 2020 compared to the recent, tapering debates that we've had pop up among market strategists. However, keep in mind that we've had Fed Chair Powell, Fed's Brainard, Rosengren, as well as Crowley, all clearly toppling that idea this week by affirming that easy policy is here to stay for quite some time, and basically just reaffirming that lower for longer theme that the markets have been banking on for quite a while. And just quickly coming back to the incoming data, even though we've seen surprising downside in some of the data points that we've had recently, like NFP, jobless claims, retail sales, etc. That is different to what we had, to the upside surprises we had back in September. But in both cases, whether now or September, markets were arguably not too focused either now on the incoming data. And secondly, the recent downside surprises was hardly a surprise for markets, because we had those renewed lockdown measures which was introduced at the back end of 2020. And with that in mind, markets were already pricing in and anticipating the possibility of some downside surprises. The big question mark, of course, is on that incoming data that we'll have for the rest of the start of the year, with that very low base effect in mind. And as always, we don't need to forget the importance of volatility. Some market participants are highlighting, a higher VIX term structure as we go into the rest of the year in the next couple of months compared to where we're trading right now, especially for the next couple of weeks. But again, comparing that to what we had at the back or the latter part of August 2020, the term structure is significantly lower in average VIX. And that has seen a lot of market participants pricing in the possibility of VIX actually finally breaking below the 20 in the next coming few weeks. So that's definitely something to keep in mind and on the radar, the developments in terms of VIX, and not only VIX, but also cross-asset volatility going into the next few weeks. So all in all then, this looks more like a temporary pullback then, in our opinion, as opposed to a major deep correction coming up in the next few weeks. Now, in terms of sentiment shifts and a trade plan, there are plenty of risk events lined up in this week ahead. We have the ECB meeting coming up on Thursday. We've got the BOC coming up on Wednesday. We also have Aussie employment data on Thursday. We've got quarterly CPI data for New Zealand coming up on Thursday. And of course, we have the inauguration of President-elect Joe Biden coming up on Wednesday. And apart from that, we also have earnings season that is set to continue, with a couple of big names coming up later in the week. Now, even though these events can act as catalysts for short-term price moves, we don't really think any of these will change the market's core expectations for the rest of the year, being a year of global synchronized recovery, a reflationary environment. And thus, our trade plan for this week will basically revolve around some of our core asset allocations and how we are looking to take advantage of the risk off route in these positions. So starting then with something like the S&P 500, we do trade the futures market, so just do keep that in mind. This will be the E-mini. Now, our bias for the S&P 500 remains bullish and remains a buy on dip approach. Friday's pullback was quite sharp, that's true, but it's still relatively small compared to the recent run that we've had to the upside. Now, the strategy for us for S&P this week is to look for key areas to add back to those core long positions that we have running from key technical levels. The first key test really is where we closed back on Friday at that 37.54 level, which is of course that 29 December high, and below that the much more attractive level to look to add some positions back in would be that 36.75, that Pfizer news high that we had back on the 9th of November. Couple of key supports coming in at that level. So key zones that we're watching for something like the S&P 500. Also then looking at the Aussie yen as a classic FX risk proxy. You know, the fate for something like the S&P and the Aussie, if we just get that back on the chart, is very closely aligned, of course. However, there's other reasons to expect the Aussie to outperform something like the Japanese yen in the next couple of quarters. There is that market's over expectation of that global synchronized recovery, that reflation environment, the market deeming the monetary policy for the RBNZ being appropriate right now, not seeing them moving into more a dovish territory for quite some time. We also have commodity prices expected to move higher. That is very good, of course, for the commodity dependent Aussie. So a couple of reasons to expect that moving higher, apart from just, you know, the risk sensitivity. Strategy for this is very similar to that of the S&P, looking for key technical support to engage from to the upside. We do have that high going back to the 31st of December. We did retest that on Friday's session, which is important to keep in mind. Did have a nice bounce from there. That should be the first area really to look for some potential support coming in just below that 80 psychological level, and then of course below that, just very similar to like the S&P, back at that 79 psychological level. Very key area of support and resistance that we'll look to add back to some key long positions for something like the Aussie versus the Japanese yen. Then coming to the US dollar, the bias remains bearish in the medium term, but in the short term there is some caution that we need to keep in mind here. The move in the dollar this week was a warning sign once again that markets don't just move in a straight line. Even though that bias remains bearish in the medium term, you know, pullbacks in these types of trending moves is both healthy and a necessary thing that needs to take place. Technically, we moved into that key area of support, you know, going back all the way to Jan and April 2018. So what we're doing right now, similar strategy to what we had this week. We're keeping a close eye on US 10-year in the week ahead, as well as inflation expectations. A further push, you know, in US 10-year outpacing that of inflation expectations should see some additional upside for the US dollar. So just do keep that in mind. But we would expect, you know, any significant rallies in the US dollar to still be met with some sellers, especially against those pro-cyclical currencies like the Aussie, the Kiwi, the CAD, as well as the British pound after those comments about negative interest rates from Governor Bailey in this past week. All right, guys, so that's everything from our side. Hope you guys will have a fantastic trading week ahead.